For those waiting for the live stream to start, this show, I'm waiting for my computer. Jay, you hearing me? Hello, everybody. And welcome to a little bit of a challenged live stream as we contend with some software updates that should not have been installed that are creating some problems. So hopefully all of you can hear me and hear me clearly. And we will get this started as soon as we can. Maybe a little rougher than usual, but hopefully we can touch on the most. Hello, everybody, and welcome. I'm Mike Coe, and welcome to Open Mic. Apologize for the delay in getting started here. We were having a little bit of technical difficulties, as you may have seen. One of the downsides of updating your Windows-based machines is that sometimes those updates conflict with things that you already had running. Such was the case for us, so we had to actually uninstall some updates just to get us to what you see before you now. Now, I had hoped to be able to show my screen, so I'm going to have to reboot some of that screen sharing software so we can do that. Things that we want to talk about a little bit today include NVIDIA earnings. We have already talked about this, but NVIDIA is 10% NASDAQ 100. So whatever happens there, it's going to happen to the market overall. Crypto, obviously, if you've been paying attention, that's been pretty hard hit. There's a couple products that actually have levered exposure to this. So Ethereum, when I saw it before my machines shut down on me, was down about 5.5%. So that obviously is going to weigh on the markets a little bit as well. And I wanted to talk somewhat about the seasonal volatility spikes that you typically see in, actually, I don't know that typical is the way I would describe it. I have previously mentioned that September, October, this time frame, actually to a certain extent November, are actually slightly higher volatility periods than the months that precede it. And actually, I had some charts that I was going to show you, so I'm going to try to pull those up as well. Let's talk about that part first. And I think I can actually get this on the screen. Let's see. And hopefully you all can see this. Ah, nice. Okay. So let's just talk about this first. So as I previously mentioned, the back third of the year or so does see higher volatility seasonally than the last months of the summer typically do. September, as you can see right here, this is for the S&P. October, somewhat higher. November, also somewhat higher. And then in December, things tend to quiet down again. Now, this is 100 years worth of data, by the way. So for a rough approximation of the S&P, this is a trailing realized volatility measure. So it's not based on what the options market's saying, just has to do with how much the market actually starts whipping around. The thing that I want to point out about this is that from a statistical point of view, because volatility is a mean reverting process, it tends to be, fairly low, and then you get these big spikes. Those outsized spikes tend to have an outsized impact on the average. So seeing that the September number is considerably above the average and that the October number is considerably above the average doesn't mean that it's usually above the average. It just means that some of the most violent movements that we've seen in the market have happened during those months, and that tends to throw it. But I think it's worth paying attention to. On here, I also have the NASDAQ 100. This is obviously a much more limited history. This goes back about 40 years to 1985. But you can see a very similar dynamic here. Okay. One other thing is that I was on a call earlier with Kevin Davitt. He's the head of index options, I believe, at NASDAQ earlier today. And he happened to mention that they are seeing more sort of bearish or hedging positioning going on in NDX options of late. NDX options, we don't talk about them that often, but I figure it's probably worthy of mention. One of the reasons they probably don't get that much mention is because people might take a look at them and say, oh, well, the volumes that you see in NASDAQ options doesn't tend to be quite so high. But I would actually say it's important to remember what the size of these contracts are. So notionally, you're dealing with a contract where the underlying is around 23,500. You multiply that by 100, and you're dealing with 2.3 million per contract notionally. So when you see 100,000 contracts trade, that actually is pretty good size when you compare it to, say, the triple Qs or IWM or something like that. Not quite the notional volume that you're seeing in a product like SPX index options, which are at the moment still the most active, and SPY coming in, I'm trying to remember, I think SPX notionally trades about 2.5 times. We could actually figure that out if we wanted to. But it is important, and I do think because it's an institutional product, just due to its size, it serves us to pay a little bit of attention to how people are positioning themselves here. The other thing I wanted to point out too is that, and I have mentioned this before, that the contango that we see in volatility, so that's how spot implied volatility compares to longer dated options, is quite steep. Now, by itself, this is, just taking a look at the VIX curve going out to April. By itself, you just say, okay, well, I just see a curve. But actually, if we compare this to where it was a year ago, I think that kind of helps illustrate the point. Because as you can see, a year ago, spot VIX was higher, but long-dated implied volatility was considerably lower than it is right now. And this is even more relevant when one considers what were we looking at in the future when we were looking at the VIX futures curve at the tail end of August and early September last year. We were looking at an upcoming presidential election. We can maybe see a little bit of a bump in here. So this is where the VIX futures are. So this is actually forward looking. So there's a little bit of a bump in volatility right in here. That's actually capturing the election. But, when a new administration, if there was going to be a new administration or a continuation of the old one, would start, making their own mark, would be in this area here, right? So the inauguration taking place January 20th. So you would start to see changes in here. And yet right now, what we're seeing is that the implied volatility for the same period in early 2026 is higher than it was for early 2025, looking ahead to the election when there was still quite a lot of unknowns. I find that very interesting, and I think it bears some watching. Okay, so in addition, obviously, to just being aware that NVIDIA earnings, which we've got coming up this week, are not only going to influence NVIDIA, which is right now implying a move of about 6%. It's going to move the market around because, number one, this is the kind of the biggest story. It's where all the CapEx at the largest hyperscalers is focused. And it's also NVIDIA alone is 10% of the NDX index. Another name that's reporting, which maybe we don't talk about quite as much, is MRVL. And I happened to write up an article about this. Maybe some of you saw it, maybe you didn't, but I think I would just quickly go over some of the things that I was talking about here. MRVL is right now trading, close to the lower end of its historical range and below the market multiple. This despite the fact that the street is looking for adjusted EPS growth in the neighborhood of year on year, in the neighborhood of 26 or 27%. And can I make this bigger? Yes, I think I can. Let me blow this up a bit. Hopefully this helps. There we go. So this is what I'm talking about right here. So 357 a share is the number that the street is looking for next year. You'll notice that it says 2027, but actually that's just because their fiscal year ends in January 2027. So it's really calendar year 2026. So if we think about it that way, we'll call it $73 a share. So that gets us to 20 times forward earnings on a nearly 27% projected EPS growth rate. And I think one of the reasons that we're seeing a multiple in this area is because this is a company that has, certainly within the last couple of years, disappointed the street more often than not. So here again, I should probably blow this up a bit. See if I can get this to a point where you guys can see it. Hopefully we can see this now. Really, it's just the last 8 quarters or so that I want people to pay attention to. And you can see right here, the stock has responded favorably to earnings only 2 out of the last 8 reported quarters. These 2 actually were pretty big pops. And then actually when they reported their Q1 24 earnings back in May of 2023, the stock jumped 32%. But I have a feeling that this is kind of what the street is worried about. Okay. So, and as we can also see, the implied one-day move, 8.8%. So one of the things I was thinking was, to take advantage of the elevated options premium and the fact that maybe the stock is not going to blow the doors off. I'm going to use a different browser here. Is, if you sold a strangle, the only problem is we saw that there was a 9% up move. We saw that there was a 22% up move. We saw that there was a 33% up move. Are we likely to get one of those moves? Not likely, but we just need to acknowledge that these things can happen. So my thinking is to sell a strangle bounded on the downside by, basically the recent lows that we had in the stock. Let me get that stock up, which is also, coincidentally, we were just looking at a Nike chart, but actually the prices in MRVL, you can see here that the recent bottom is right around the same level. On the upside, though, what you would probably want to do here is actually cover a short call by just making it into a credit call spread. So let's do this. I'm going to just shorten this up. We'll go to 39 days. I was looking at the 85.90 call spread on the short side. And then selling the 65 puts. And I didn't do that quite right. Let's see. Oh, whoops. That's why. Sorry for that. I was moving the wrong strike around. Here we are. And you end up with a structure like this. Downside, actually, what was the delta of this put today? That's a little bit on the high side. Maybe we take it down here. End up with a structure like this. Pretty good standstill rate of return. What are we looking at here? If you trade this at 295, we'll just compare this to the risk on the put side. So if you're put the stock, it's going to be 295 over 63. That's about a 4.7% standstill yield relative to the put strike. And obviously it's going to be lower on the call strike side. But the worst case loss to the upside is going to be the difference between the strikes of the call spread less the premium you've collected, which is about $2. So, you can adjust the downside put strike as you see fit. But I did notice that there was a little bit of additional premium in here. And I think it's kind of bounded by, number one, underperformance from an operating perspective over, several years now on the upside. And the fact that the stock's, been pretty hard hit and underperforming and is relatively cheap. So you're kind of playing off the valuation thing as a boundary on the downside. And, number one, you're going to be collecting some premium, but also the fact that the stock hasn't exactly blown the doors off over the course of the last, we'll call it 8 to 12 reported quarters. There was a couple periods in there where we got big pops, but as you saw, in general, it hasn't been all that enticing. So I thought that was kind of an interesting trade and setup, which was worthy of mention. Now, there were a couple things I wanted to talk about today other than NVIDIA and MRVL. One of the other things I wanted to talk about was when we were discussing potential rate cuts, we looked at the FOMC minutes a week ago, and it seemed fairly hawkish. And then, all of a sudden, later in the week, Jackson Hole comments, much more dovish. I personally suspect, and I think one of the other things I would say here too, is that Jerome Powell specifically mentioned that, there can be some differences of opinion, so that they're not going to have complete consensus on this. And I think that's kind of important because it suggests that, to me at least, I think there's a possibility that they may focus a little bit more on labor market weakness than inflation. And if that's true, that suggests that, the probability of a rate cut in September is a little bit higher maybe than we had thought it would be when we were just looking at the FOMC minutes. All right, I'm going to try to bring up my social comments here in case any of you are asking any questions, but I'm not sure that that's actually working yet. Let's see here. Okay. It should be, but again, we're just dealing with some technical issues, and I appreciate your patience with that. Here we go. Oh, there are a couple. There we are. All right. So let me go this way. All right. Ranjana Gupta says, on Friday's Fast Money, Carter Worth was bullish on LYFT. Could you please provide your fundamental analysis and draw up a trade? Yeah, he's not the only one who's been bullish on LYFT. I think Tim Seymour, you guys can double check this, but I'm pretty sure that Tim Seymour has said on more than one occasion that this was a position that he holds. And why don't we just take a quick peek at the financials? This one is cheap compared to Uber. We can see that right here. It's trading, less than 17 times full year earnings this year, and if the street's estimates are correct, and so what do we have? We've got 13% year-on-year top line growth here. Full year adjusted EPS numbers of $1.08 a share. So that gets us to less than 16 times this year's earnings. And perhaps more remarkably, because you're still looking at another 14% year-on-year anticipated top-line growth for next year and 27.5% adjusted EPS growth, 12.4 times earnings. So if that's true, then, and they can keep that kind of thing up, yeah, I would certainly say it's cheap. It's certainly a lot cheaper than Uber is. Let's take a look at that one just for comparison's sake, so you guys can see the difference. Oops, I don't know why that one didn't blow up, but we'll just do that here. Okay, so if you take a look at Uber, that one's anticipated to make $4.11 next year, which is slightly lower adjusted EPS growth, slightly better year-on-year top-line growth estimated here. And if we take a look at that, that works out to 23 times the anticipated adjusted EPS numbers for next year. Also, you have a 5% free cash flow yield anticipated next year. That's obviously pretty positive. But just to put things in perspective, that means that Lyft is trading at about half the multiple that Uber is, right? So rough back of the napkin way to look at it. Taking a quick peek at the technicals for Lyft here. See what we've got. We'll just rank these by the better performing strategies like this. I like to ignore buy and hold. Recent strength probably pushing it towards the upper end of the Bollinger Band. Why is that not ranked the way I want it to? There we go. So the top 3 technical indicators aren't overwhelmingly positive for Lyft, but a few of the other better performing metrics are. I'll let you guys take that as you will. But as Ranjana pointed out, and I'm trying to remember, I was actually on fast money for a brief period on Friday. It was only for a moment, though, because I happened to be, if anybody happened to see that, you probably noticed that I was not at this desk. I was up in Sonoma, so I didn't actually hear what Carter had to say about it. But if he says, if Ranjana says that Carter said he was bullish, we'll just go with that bullish thesis and stick with that. So with that in mind, then we will frame up a bullish trade. Oh, one other thing we should probably be taking a look at: what are the upcoming catalysts for Lyft in the next couple of months? I don't need to go back in time, so we just have earnings. That's it. Between now and let's just go to the end of the year. Let's see what this schedule looks like. Yeah, so we just have earnings coming up first week of November. That's basically it. So, and now we'll do one more thing, which is take a look at volatility. How are options priced? So we've got the implied volatility for options in white. We have the realized 30-day trailing volatility in orange. I'm going to expand this to 2 years so we can actually get a better visualization of the impact of earnings. Pretty easy to see that here. So there is a pretty notable uptick that takes place. But, this is actually a pretty respectable implied volatility to catch as long as you are, between those kind of big events. So if you're long the stock and you're thinking about doing something like a buy right, I think that's fine. Something like a call spread risk reversal might not be bad either. So why don't we structure that up real quick? Okay, so let's see. Where's resistance? 1760. That seems a little bit close. What's the next point of resistance? $18. I mean, I might actually just think about, doing something like this. Something like an October 19 buy right. 62 cents may not sound that exciting, but remember, this is only a $17 stock. And, implement a wheel strategy. I think that would be a fine strategy in here. Get yourself a little bit of standstill yield. You could choose a slightly earlier expiration if you wanted to. I think that's fine. Maybe, go to the October 13s and then take it in a little bit. But yeah, to me, I think that's probably a fine way to go. If you guys haven't guessed, I mean, my inclination is we've had a heck of a rally. I kind of like being in, generally in equity buy rights here because I'm not expecting these stocks to blow the doors off. And also I'd like to see folks collecting a little bit of premium so that you can have some index put spreads on, which we talked about a week ago and a couple of times actually of late. And, you know, if you have that as your general position in your single stocks, you're still going to have positive carry on the options part by, you know, putting on, you know, a close to at the money to 5 or 7% out of the money put spread in whether it's SPX if you're using that, or NDX if you're using that, or the triple Qs. But that's basically the setup I favor right here. Collecting premium on the single names, still preserve some upside, but just recognizing that, you know, we've had a number of years of really strong equity performance. Valuations are not insane. You know, I did show that price to book chart a week ago, but I think it's also important to remember that, you know, when you look at a historical price to book chart, you know, the nature of businesses 20, 50, 100 years ago, very different than modern technology businesses. So I do feel like valuations are, you know, getting towards the upper band of where I feel comfortable, but, you know, and there's a little bit of shock and awe when you show one of those price to book charts, or maybe even a price to sales chart also, just because some of these businesses like NVIDIA have such incredible margins. We've never really seen anything like it before. But still, you know, in the case of NVIDIA, you end up bumping up into the laws of large numbers. You know, just don't get too greedy. And in many cases, you still have plenty of upside if you do structures like this. So I hope that helps. Let me bring this thing over here. All right. Kirk says, can you provide a game plan for closing a vertical spread using theta and gamma with possibly a real world example? Also, if you wanted to own the security, I think that assumed, let it expire in the money. Let's see here. Can you provide a game plan for closing a vertical spread using theta and gamma with possibly a real world example? So in terms of when I like to close spreads, I'm not focusing a whole lot on these things, but I will say this. Let's use SPY as an example here. Things to think about. As I previously said, when I see options go to about a 60 delta, that's when I start looking for adjustments. Whether it's a credit trade or debit spread, either way, you are now dealing with an option that has a greater probability of expiring in the money than not. Now, if you had a view, let's just say you were bullish, and so you said, okay, I'm going to have a long call spread on. And so we're at 642.5. Let's do this. And I'm actually going to put this thing in the money. This is 57 delta, but let's go over 60. Okay, so we'll imagine that you put this trade on a while ago. Okay, I'll go like this. I'll assume that you put on a 45-day trade 17 days ago. Where was it 17 days ago? So we're going to get into, we're probably $10 lower. And let's say that now this is a vertical spread you put on and it's well in the money. It should probably serve as a decent hypothetical here. Let's go like that. Okay. All right. So you bought an out or at the money call spread, and now it's in the money. All right. Well, let's just take a look at this trade for a second and see what kind of characteristics it has. When you bought that trade initially and it was at or slightly out of the money, you were paying theta. And I think this might be what you're getting at, Kirk. I'm not sure. You can throw in an additional comment if you like. If you are long a vertical spread and it runs well through the long strike and it actually gets closer to the short strike, a position that had negative decay may now actually have positive decay, right? And the opposite's also true. If I sell a credit spread, credit vertical spread, but it runs through my short strike, it may actually end up going from a positive theta trade to a negative theta trade. So in this example, the debit here is $15.52, and that is 12.5 bucks in the money. So we're still actually paying away. Now let's imagine instead, I'm going to just bring this down a little bit more so that I can get to an example that actually is positive theta. Here we go. This probably is. So the 625, 650 can be worth as much as $25. At 642.5, oh, this one's pretty much, actually, this is neither positive nor negative decay, looks like. Pretty much spot on the money. Yeah, so this trade is basically no decay, right? Because it's basically trading right for intrinsic. And if I bring these down so it's even further in the money, 620, 645. Oops, yeah, 645. Okay. So here you have a $25 structure. It is potentially, it's $22.50 in the money, but it's only trading for $19.35. So this trade, assuming SPY just stayed right here all the way to expiration, would actually be worth more money as time passed. So that's a positive theta trade. So can you do that? And would you? You can. One way to think about this is that you kind of have like, some might call it a poor man's buy right on. You basically have a buy right because the 620 is a proxy for stock and the 645s are just a short call. And those are, if this was really deep, you could see what I mean, because I can find a call option that's trading very close to intrinsic value. Like these 615s are probably pretty close. Right? So that's fine. And what will happen if you carry that all the way to expiration is you're just going to end up being long the stock after expiration because you'll exercise the long calls if the short ones are out of the money. Nothing done. And then you're just long the stock. And then you can do the same thing again. So, yeah, that's fine. I tend, though, not to adjust my options positions based on calculations of theta for a vertical spread. First of all, I might have a couple more legs in the trade anyway. But what I am interested in is those strikes which are closest to being at the money, whether I was long or short, trading maybe a 30 delta option. Once it gets to 60, I typically will roll those. So I don't know if that really helps too much. I don't give gamma a whole lot of thought in this context. So I don't know if that's not the answer you were looking for, but admittedly, it's not really the way I think about it too much. I like to take a look at the rates of return. I like to look at the deltas. I like to adjust the positions fairly dynamically once the deltas get to 60 or above. That's kind of the way I do it. But it is worth noting that negative theta trades can become positive theta trades can become negative if you just sit on a vertical and you just let the underlying run through the long and short strikes. So, oh, you're looking at a specific trade here. Okay. Let's see what you have. I should have scanned ahead, and then we would know. So you have the 60-70 call vertical in KTOS defense. Stock's trading almost 67 bucks, so it's well in the money. Okay. These are 829 weeklies. There we go. So these are actually, yeah, I mean, you've got expiration coming right up. Yep. Yeah, so that's fine. I mean, look, this has almost no time to go. The 60s are essentially stock. Stock plus a really cheap put. Because the stock's trading almost $67, and these puts, I mean, these calls are $7.20 on the offer. If I go to the mid-market, $7.10. So, yeah, I mean, that's totally fine. You know, that this position, you're going to collect 1% of the underlying better than that by the end of the week. Yeah, that's totally fine. The example I was providing was a little bit further out in time. So in this case, you're now positive theta. It's like a week ending buy, right? I think that's a fine trade. Okay. Alex V. You are looking at AeroVironment earnings. Supposedly going to be September 3rd. I've got September 4th. But we're on the same week at least. 9/12 implied, oh, this is good. Okay. Implied volatility for the following week is much higher. Maybe buying the Sep 5th 247.5 call and selling the Sep 12 267.5s against it. All right. Well, this is interesting because, well, let's take a look at this. I'm going to get rid of where this was last week. Yeah, this is interesting because what this tells us is the options market believes earnings are taking place the week ending September 12th, not the prior week. That's what that tells us. And the reason is because, and this just got into my ear, because they are not going to be reporting on the 3rd or the 4th, as Bloomberg has it. Apparently, Business Wire says that they are going to be reporting on the 9th. So, yeah, so that just came across. So you don't want to, essentially what would be happening is you would be buying the non-event and selling the event if you did that trade. And this is actually kind of an important lesson. I mean, we've gone over this topic a couple of times, but when there's, and this is unusual because generally speaking, companies will announce when their earnings are going to be released sooner than this. This one's a little bit late. So let's take a look at it. They probably have it right on their investor relations. So we'll go over here. And right here we are. Okay, so this is off the company's own website. And here, after the market closes, September 9th. I hope everybody can see this on my screen. Okay, so yeah, just exercise a little bit of caution. It seems like the options market, this was just released at 4:10 Eastern today. Today's, yeah. But the options market knew that ahead of time because that is the vol surface from before the market. That's as of the market's close. So the company announced it at 4:10, but at 4 o'clock, the options market had it priced that it was not going to be reporting earnings until the week ending the 12th. So a good, we try to look for multiple pieces of data to align. And what we do know, and we have seen, is that there have certainly been miscalculations and misreporting on the estimates for when companies would come out with their quarterly earnings releases. For example, last year we saw a whole bunch of these because people use algorithms to do it. And for whatever reason, it looked like they hadn't accounted for the leap year. So things were getting thrown off a little bit. one of the things you're doing really well, Alex, is what's the first thing you did? You took a look at when various parties were saying this is when earnings are going to be, and then you looked at the vol surface to see if it was consistent. The important thing that you need to do after you've done both of those pieces is say, okay, well, which of these two pieces of data do I believe? Do I believe that the options market has it right, which is going to be Citadel, Susquehanna, Jane Street, all of the traders at those places, plus the flows of all of the options market participants? Or am I instead going to just rely on the one, estimate, which is probably algorithmic, that says they're going to report on the 4th or the 3rd? You had the 3rd, Bloomberg has the 4th. It looks like Bloomberg is clearly wrong because the company said, no, we're coming out on the 9th. So I probably would not sell the 267.5 calls in this case, but I'm assuming you know that already. Okay. And I hope all is well in Orange County. Okay. By the way, acquiring stakes 10% in Intel in the large chip companies, isn't it a, quote, socialist, unquote, like move, opposite to the Republican and libertarian views? You are referring, of course, to the announcement by members of the administration, including my former boss, Howard Lutnick, that they are going to own 10% of Intel. This is rather curious. One of the things I would say is authoritarian governments, some people would say that far right is fascism and far left is communism, and there you have various things in the middle. I would say that both of those extremes actually have more in common with each other than they do any libertarian view of the world, because both of them have elements of government authoritarianism. Both of them suggest that the government should own or control or have significant sway over the means of production. So I would say, yes, it doesn't seem particularly libertarian to me when governments start acquiring parts of companies. Now, there could be reasons why that happened. If there's a bailout and they guarantee debt, that I believe in that case, taxpayers very well and fully deserve to be compensated for the risk that they took, to bail them out. So whether that's financials or whomever, I don't think that taxpayers should be asked to bail out private industry and then get nothing in the event that those companies rebound. That doesn't seem right. But the idea that government should start acquiring percentages of our publicly traded businesses, I'm not enamored of that, to be honest. I guess I can probably leave it there. I don't really know what else to say about it. It's an interesting dynamic that would happen, and I'm not really crazy about it. GCW, hello from Sharpsburg, Maryland. Hello to you. Steve Garcia, hi Mike. Happy to exit the CSX trade 3 weeks ago for a 70% gain. Nice. I'm specifically interested in CRWD and BABA earnings this week. CRWD has retraced 20% from its all-time high, and BABA is always mysterious. Yeah. Well, yeah, BABA, there's the interesting thing, of course, with BABA is that you're contending with, the discount that we typically see applied to Chinese companies, and the interplay of U.S. to Chinese equities is always kind of an interesting one. It typically trades at a valuation that you would never see for a Western company in the same space growing at the same rate. We'll just take a quick peek and illustrate this. So off of its lows, but we can see that it's still, if you had a company that was growing at this rate, I think it's pretty safe to say you would not expect to see it. Let me just convert this to dollars, because otherwise this is not really helpful. You would not seeing it these kinds of multiples. So the what we could trade in the US, which is the ADR BABA, that's at 100, let's just call it $125 and 10.5 for next year's numbers, just to, that's less than 12 times forward earnings with a 20% adjusted EPS growth rate, and very nice free cash flow as well. I think it is worth noting that we should be a little bit leery when it comes to looking at these companies, because we were just talking about authoritarian regimes and their ability to do stuff. Well, China, the Chinese government, we saw what happened to Jack Ma, right? Didn't he just go missing for a little while? Nobody saw him, and a couple other folks. If they decide they want to do something, they can, and they will do it unilaterally, and that'll be that. And that is a risk factor, right? That said, I do feel like the valuation is reasonably compelling here. Let's take a look at vol. Wow, that's fallen off quite a lot, hasn't it? I didn't realize. But the options premium is still up, but the realized vol is, let's get rid of I'm going to get rid of the implied vol so we can sort of see what I'm talking about here. Draw a line just to give it some perspective. So here we are. I guess it has been meaningfully lower. But and now we'll just take a look at the implieds and get rid of the realized. So I'm looking basically at the difference between how much the stock is actually moving, or the ADR in this case, and how much the options market is implying that it will. And we can now just take a look at the difference between these two. Go like this, and there. So when that number is high, you want to be short options, and when it's low, you'd rather be long them. Because you can think of this essentially as the value you're getting for owning options. And right now, you're paying a significant premium. So why don't we take a look at the stock's performance of late and how the technicals are setting up. Kind of a mixed bag. Yeah, so options are a reasonable sale. Probably going to bump its head over here, I'm going to guess. And there's probably some support down here. So 125.35 call spread, funded possibly by some puts in the 110 area. When are they reporting or expected to report? Don't get really big moves out of earnings. So let's just take a peek how that sets up. We'll go out 6 or 7 weeks, 6.5 weeks. I probably should have left this up and running, but here we go. $125, $135, maybe the 140s actually, since we've got earnings in there, or even maybe the 145s if we get a breakout, something like that. Support around. Okay. So that would get us in this neighborhood over here. I'm just going to pick the 110s. That's actually a slightly lower delta than we might otherwise select. Something like that. Again, we don't mind being short a little bit more options than we're long, simply because it seems like they are arguably a little overpriced. So yeah, that would be a way to do that. Steve Garcia, audio is not working well. Nothing. Yeah. Well, I'm being told to skip all these comments, but it's one comment here says, seems like a mic is out of battery power. Yeah, I'm not using battery powered microphones, but this one can take phantom power. This is a Shure SM7DB, I think, for those who know something about microphones. Yeah, old comments, we get it, but I was asked, somebody had made a comment once before because I was on CNBC and the gain was all screwed up, and somebody said, buy a decent microphone. I have decent microphones, or at least from what little I know about microphones, they seem to be decent microphones. But, things like Shure microphones and Sennheisers and stuff like this, we've experimented with these things to try to see what works. But yeah, our problem was software and bandwidth related. Okay. Dan Winterhalter says, MRVL has been a part of ULTY for some time, I believe. Nice implied volatility. So, yeah. Take a quick peek here. I don't know if anybody's really interested in talking about the YIELDMAX funds. I like to take people's questions on the things that you guys are looking at individually. But one thing I would quickly point out, first of all, the things that are in here are dynamic, so they're going to change. But MRVL is in ULTY. SALTY, which is the bearish version, is not necessarily in the same stock. So these funds are fully transparent, as many ETFs are. So if you have questions about what's in them, the ETF providers, including YIELDMAX and Title, will release all of the holdings. And one of the things you can see is that if you take a look at Salty's holdings, there is no MRVL in it. There is an ULTY. So just an important tip that not only is ULTY bullish and Salty bearish, they each are taking different directional views, but they have different underlying stocks, and both are looking to collect premium on balance. So, they're both in, a buy right and maybe I can't really call it a short right on the Salty side. Really what's going on there is, it has a bearish tilt with short delta, but it's still just looking to collect premium. And if you take a look at the holdings, you'll see that it's going to have, some measure of limited risk. It's not taking unlimited risk, but hope that helps. Dan, hey Mike, love the show. Punch that like and subscribe button. Yeah, hey, we appreciate that. Kind of got off to a rough start today, didn't we? With updates. So we had security updates on the computers, and then we learned only after the fact that the software that is used to share screens on live streams like this one don't play nice with those security updates. So we then had to undo those, and that's what was taking us so long. So I apologize for that, but appreciate your patience. I've been selling SPX bear call spreads, 5 to 10 delta, 30 days out for income. Thoughts in this overpriced market? So, selling an upside call spread would be the same as sort of buying an in-the-money put spread, right? And I've recommended buying put spreads on SPX. I like selling upside calls against individual or call spreads against individual stocks to buy downside put spreads in SPX and against, your long stocks. So you still have some upside. It's going to reduce the positive carry that, say, a buy right position is going to have in general because you're going to be buying some insurance. And if anything is generally true with respect to options prices, that there is more persistently a volatility risk premium to index options than there is necessarily in single stock. Not my work. That was some work that I saw that the folks over at Options Research and Trading Services, also known as ORATS, that's run by Matt Amerson, that you do see some persistent premium on the index side more commonly. So consequently, value for, and plus, as I pointed out, as Kevin Davitt from the NASDAQ had said earlier today, that might be even a little bit more true because we've seen a little bit more hedging in the NDX options complex, for example. So that's going to elevate the prices of those downside puts even just a little bit more. In fact, we don't need to speculate. Why don't we just compare what that looks like? So I'm going to do this. This is the NASDAQ 100 index. I mean, I usually use SPX when we have these conversations, but since I was talking with Kevin earlier today, and here you can see what I'm talking about, right? So that premium right there, and we'll do the same thing that we did for BABA to get a sense of the premium. So when this is a positive number, and it is right now, options are pricing in more volatility than we're actually experiencing. But the flip side of that is it's not crazy. And what happens when you get huge volatility like we did in April? You're paying a couple percentage points over to own it. But if it hits, it hits in a really big way. So, yeah, that happens to be the trade I like, and it's just because we are coming into this choppier period. I think there's division at the Fed, and it's not just division. We're very data dependent, and we still have more inflation data to come. The most recent inflation prints weren't great, and the most recent labor prints and revisions weren't great. That's kind of an unhappy combination. I hope that we get good numbers out of both. And happy times are here again, and wouldn't that be nice? But we need to acknowledge that if those were symptoms of a trend that's going to get a little bit worse, a correction is certainly a possibility. And it's not going to cost you a whole lot to sell some calls against your single stocks and buy some index here. So, all right. Dennis Yavi, iOS beta also updated today. I do the beta updates also for my iOS devices. I didn't happen to notice that updated. I'm going to have to replace this thing, and I intend to when the 17 comes out, if it's any good. We're going to have that news also actually around the time that AeroVision is going to be reporting earnings. So the new iPhone release is probably going to be the second week of September, and that's going to be interesting. One of the things I heard about it is that it's going to have a much brighter display for those who use it in bright sunlight, which is helpful for me. So I will probably upgrade when the time comes. FinWest, Aloha Mike, happy Monday. We talked about a risk reversal in CSX last June. I think a viewer raised the idea that you endorsed. Yeah, I closed it out with a nice gain. Thank you for that. Oh, okay. Wait, didn't somebody else just say that? Or did you say it twice? My mistake. I know that somebody was talking about it, but yes. And, then, of course, we had a merger in the industry as well. Stephen, please talk more about YIELDMAX ETFs, more about NAV erosion control and yield. Let me just make sure what page I'm on. Okay. So, yeah, let's talk a little bit about that. For those who are interested, NAV erosion And I hear some people talk about it as decay. It's not decay, because if you have a portfolio that is doing buy rights, decay is actually a tailwind, because you're basically synthetically selling puts, right? So let's just take a look at ULTY as an example. So you have a basket of underlying stocks, you own those stocks, and you're selling calls against it, right? You're collecting decay. So there's not NAV decay. However, it is true that the value of the shares after the distributions have been made go down over time. And one of the reasons is that these funds, in addition to paying out dividend income, interest income, if any, the premium that you're collecting on the option side, also distribute a portion of the gains to the shareholders. There are actually certain ETFs, I won't bother to name them, but there are certain, who issues these, but there are certain levered ETFs that aren't even really selling options at all. All they do is take on a little bit of leverage and then distribute some of the gains. So that NAV erosion, some return of capital to the investor, I don't think people should look at this as a bad thing. You as a holder have the option to reinvest a portion of the dividends if you choose, to stabilize the allocation that you have to that specific asset. So you can see here, this used to be a monthly distribution. It's gone to weekly. But you can also see over the course of the last year, the returns have been quite good, right? So the total return, had you reinvested, would be 22.74%, which is better than if you had done the same in SPY, right? So we can take a look at that. This doesn't pay big distributions, but there are some. So the total return is about 15.7% if you took your dividends or distributions out of SPY and reinvested. ULTY, 22.7%, so pretty considerable outperformance. If you wanted to stabilize it, you could take those distributions and say, all right, well, I'm going to reinvest a portion of those. And how much you decide to reinvest is totally up to you. But that sort of dividend reinvestment plan, if you will, just gives flexibility to the individual holders, how they're going to do it. Now, whether you elect to do this also depends. There are tax implications if you have different, if you have this in a Roth IRA, there is no tax implication. If you have it in a self-directed IRA, there's no immediate tax implication. If you own the shares and you're looking at distributions characterized as return of capital, that's generally going to be favorable for the shareholder. It lowers your basis in the shares, but it's not the distribution itself. That return of capital portion, if that's how it ultimately characterized, isn't taxable. So there's kind of a lot of moving parts here, but I think that's something worth considering. You can, reinvest a portion of it. My point about this is, just keep your eye on the total returns. If the underlying assets start to fall, and that can happen, right? So that's happened there's a single stock one called Misty, which trades MicroStrategy. And, you're going to see that the price for Misty has fallen. A big portion of the reason it has fallen also, the total returns for that are actually pretty good over the course of the last couple of years. You can see that it was a nice return from a year ago. But one of the reasons that it hasn't been doing so well of late is because MicroStrategy has not been doing particularly well of late, especially within, since the July highs here was 460 and change, and now 343s are down. We'll call it it's down $120, 25% or so, maybe a little bit more actually. That's going to weigh on any buy right strategy, right? So anyway, Now, I know we got off to a late start, and I apologize for that. I don't know exactly how late we got going because we were sort of fumbling around over here to make things happen. But I think it has been about an hour or maybe a little bit more. And I appreciate your time and your patience very much, particularly when we are bumbling around as we did here a little bit. My fault. Should do these updates and test them at other times. But unfortunately, when there's a trading day going on, sometimes you think, oh, we'll just do this update as soon as we have the market closed so that we don't interrupt the regular trading day. And then we end up interrupting the live stream as we did today. So thanks all of you who stuck around and put up with that. And hopefully it'll go a little smoother when we come back and see you guys on Wednesday at 4:15. Thanks for watching.